We now come to the second major segment of this reading, which is supply analysis. Here we will cover marginal returns and productivity, break-even and shutdown analysis, and economies and diseconomies of scale. Let's start with marginal returns and productivity. The first thing to do here is understand some basic terminology. For any firm or any production process, there need to be some inputs. These inputs are called the factors of production. The two most commonly cited factors of production are labor and capital. Now obviously there can be several other factors of production, but in this reading we'll focus on labor and capital. Now typically L will stand for the number of units of labor, K will stand for the number of units of capital, and this is often in terms of the number of machine hours. The labor rate is generally a wage rate, and the capital cost can be in terms of a rate also. So we assume that the capital is rented or leased at a particular rate R, and this is the number of units of capital used in terms of machine hours. So these are the factors of production or inputs. There is a production process and then there is an output. The output is often called the product. Now total product is the total output produced. So if we are manufacturing or producing chairs, and let's say a given period is defined as 1 month, and we say that the total product is 500, this means that in one period 500 chairs are produced. The average product is with respect to a given factor of production. So we can say that at a given level of capital, the average product of labor is equal to the total product divided by the amount of labor. So if the total product is 500 and labor is 2, then the average product will be 500 over 2, which is 250. The marginal product of labor is the additional amount of output or product that we produce by using one more unit of labor. The marginal product of capital is the additional amount of product that we produce by using one more unit of capital. So when we consider the marginal product of capital, we are adding one more unit of capital but keeping all other factors of production constant. Similarly, when we talk about the marginal product of labor, we are changing labor, so adding one more unit of labor but keeping all other factors of production constant. Let us now compare three companies, X, Y, and Z. For each company we have the output, the labor hours, and the average product of labor. If the question is which company is the biggest, then the answer clearly is company Z because it has the highest output. But if we ask which company is the most productive or which company is the most efficient, then the answer would be company X because it has the highest average product of labor. This average product of labor is the output divided by the labor hours. So compared to Y and Z, company X is more efficient. Now let's go a little deeper into the total, average, and marginal product of labor. So consider this table. This is the number of units of labor. This is the total product. And this is the average product. This is the marginal product. So what this is saying is with 1 unit of labor, the total product is 250. Average product 250 is equal to this divided by 1. And this 250 is saying that when we add this first unit of labor, the additional output produced is 250. Now going from 1 unit of labor to 2 units of labor, what happens? The total product increases to 525. The average product is 263. So where did this come from? This is 525 divided by 2 and then rounded up. What about 275? Where is this coming from? this is the difference between 525 and 250. So when we add this unit of labor, the additional output or the marginal product of labor is 275. Now in this analysis, we are keeping all other factors of production constant. We can have a similar table for capital, where we'll have units of capital over here, the total product, and then if we are dealing with capital, then this column would be the average product for capital and this would be the marginal product for capital, but the table will look essentially the same. Now I also want to point out the concept of increasing and decreasing marginal returns. So over here, up till the second unit of labor, we have increasing marginal returns. So notice as we go to the first laborer, our marginal product goes up to 250, then our marginal product goes up to 275. So as we are adding more labor, our marginal product is increasing. But then after this, we have decreasing marginal returns because adding more labor causes the marginal product to decrease. And in fact, if we have too much labor, then the marginal product is actually negative. Notice a strong link between input productivity, which is essentially this column. So this is the average product, which is total product divided by units of labor. So there's a direct link between the average product and marginal returns. As the average product is increasing in this range, the marginal returns are also increasing. But after this point, the average product is decreasing and the marginal product is also going down. Break-even and shutdown analysis. At a very simplistic level, we break even when total revenue is equal to total cost. And in terms of shutdown analysis, if our profit is less than zero or the profit is negative, then we should shut down. Here we need to consider shutdown decisions in the short run as well as the long run. But clearly there is a lot more to this. We need to get a little deeper into the definition of profit, and we need to develop an understanding of different revenue concepts as well as cost related concepts. So let's start with profit. You need to understand the distinction between economic profit, accounting profit, and normal profit. I will explain this through a simple example. Let's say that we start a business and our equity capital is 100 million. So we invest 100 million. Our required return on this equity is 10%. So in other words, our opportunity cost of employing this capital in our business is 10% of 100 million, which is 10 million. Now this business has a revenue of 200 million. And let's say that the actual accounting costs of this business are 190 million. So in accounting terms, our profit is 10 million. Notice that this 10 million does not consider the opportunity cost. If we do factor in the opportunity cost of 10 million, then our profit is zero. Now in this example, given that the 190 million is an accounting cost, we say that this 10 million is our accounting profit. And then after we subtract this 10 million, we get zero. This 10 million is our opportunity cost, and our economic profit, which considers the opportunity cost, is zero. Now in terms of definitions, we can say that economic profit is equal to total revenue minus total economic cost. And in our example, the total revenue was 200, the total economic cost was 190 plus this opportunity cost of 10 million, which was 200. So our economic profit here was zero. The accounting profit is equal to total revenue minus the total accounting cost, and in our case the total revenue again was 200, the total accounting cost was 190, so our accounting profit was 10 million. So notice that the distinction between accounting cost and economic cost is that the economic cost includes the opportunity cost. Now, taking this one step further and talking about normal profit. There are two ways of thinking about normal profit. One way is that the normal profit is equal to the accounting profit when the economic profit is zero. So here, in a situation where the economic profit is zero, the accounting profit is 10. So we can say that the normal profit is 10. The other way of looking at this is that the normal profit is the opportunity cost. So remember, the opportunity cost in our example is 10 million. So that is the normal profit. Now the question is whether an economic profit of zero is a bad thing. And the answer is not really, because an economic profit of zero still means that we are making an accounting profit, and that accounting profit is essentially covering our opportunity cost. The second point on the slide has to do with marginal revenue. Marginal revenue is the additional revenue from increasing output by 1 unit per time period. And the formula is change in total revenue divided by change in quantity. So let's consider a very simple example. Let's say that we are making widgets and initially our total revenue is 100,000. And at this stage our quantity is 100 units. From here we move to a revenue of 150,000, and here we are producing 125 widgets. So what is the marginal revenue? The marginal revenue will be the change in total revenue, which is 50,000. So that's 150,000 minus 100,000 divided by the change in quantity, which is 25. So we can say that our marginal revenue here is 2,000. Now this is a formula that you need to remember. Marginal revenue is the change in total revenue divided by change in quantity. Very broadly speaking, we can have two sorts of environments. We can either have a perfectly competitive environment or an environment where there is imperfect competition. An example of a perfectly competitive market is where you are, let's say, selling oranges. Now, when you are selling oranges, the demand curve that you face is flat. So if you have quantity, if you have price on the y-axis, quantity on the x-axis, and let's say that the market price of oranges is, let's say, $10, then this is the price that you face. So no matter how much you sell, you will be selling for $10 per unit. So in a perfectly competitive environment, we can say that the marginal revenue, which is the revenue from selling one more unit, and that is 10, this marginal revenue is going to be equal to the average revenue. So the average revenue is the total revenue divided by how much you sell, and in this environment that average revenue is going to be equal to the marginal revenue, and that's going to be equal to the price, because when you sell one additional unit, the revenue that you get from that additional unit is the price. So keep this in mind. In a perfectly competitive environment, marginal revenue is equal to average revenue is equal to price. But what if we do not have a perfectly competitive market? Then we have a downward sloping demand curve, and the marginal revenue curve will look something like this. It will be inside the demand curve. Now, what is the marginal revenue in this sort of an environment? So remember our basic formula. The marginal revenue is the change in total revenue divided by change in quantity. So in this sort of an environment, the change in total revenue is equal to price times change in quantity plus quantity times change in price. And we say that marginal revenue is equal to this divided by change in quantity. So if we divide this by change in quantity, and this by change in quantity, what do we have? The change in quantity cancels out. So in this particular case, where we have imperfect competition, we can say that the marginal revenue is equal to price plus quantity times change in price over change in quantity. So here is another formula to remember. In an exam setting, you might be given the price, you might be given quantity and this ratio, and you can then calculate the marginal revenue. Next, we talk about the concept of marginal cost. Marginal cost is the increase in total cost from increasing output by 1 unit per time period. Here you need to understand the distinction between short-run marginal cost and long-run marginal cost. In the short run, we generally say that most factors of production are fixed and the only factor of production that is variable is labor. So another way of looking at short-run marginal cost is what is the additional labor cost of producing one more unit? And the expression for that is W, which is the cost of 1 unit of labor, so this is the wage rate, divided by the marginal product of labor. Now, to quantify this, let's say that we are working in an environment where the cost of 1 unit of labor is 100, and let's say that the marginal product is 2. And remember from our earlier discussion, the marginal product is the additional output from using one more unit of labor. So that's the marginal product of labor. So if the additional output from one more unit of labor is 2 and the cost of 1 unit of labor is 100, then we can say that the short run marginal cost is 100 over 2, which is 50. So keep this in mind. What about long run marginal cost? Long run marginal cost is the cost of producing one more unit where all factors of production are variable. So remember both of these terms. Moving now to average variable cost. The average variable cost is simply the total variable cost divided by the quantity produced. That's fairly intuitive, and along the lines of what we saw earlier, the average variable cost can also be computed as the cost of 1 unit of labor, which is the wage rate, divided by the average product of labor. The final point on the slide has to do with fixed costs. Fixed costs generally stay the same over a given range, but move to another constant level when production increases. So in a given factory, we might have our equipment, and this equipment can produce between 1,000 and 2,000 units. Let's say our production level increases beyond 2,000, so we will need to increase our equipment. In other words, our fixed cost goes up. So a question comes up, is this really a fixed cost? Because the cost is changing when our production increases beyond 2,000. And economists refer to this cost as a quasi-fixed cost, and these quasi-fixed costs are also generally categorized under fixed costs. So even though our equipment might increase, it is a quasi-fixed cost which is categorized under fixed costs. Normal profit is also generally categorized under fixed costs. Now remember, one definition of normal profit that I talked about earlier is that this is the opportunity cost. So you might invest $5 million in purchasing equipment. That 5 million could have been invested elsewhere. So there is an opportunity cost associated with that investment. That opportunity cost represents normal profit, and that is also categorized under fixed costs. On this slide, we look at the different cost curves. Here we have a very simple depiction of total fixed cost, total variable cost, and total cost, which is simply the total variable cost plus the total fixed cost. The graph on the right is more interesting. Here the red line represents the average fixed cost, which is the total fixed cost divided by quantity. Obviously, as quantity increases, the average fixed cost comes down. The black curve is the marginal cost. This is the additional cost of producing one more unit, and we notice that here initially the marginal cost comes down and then it moves up. The green graph is the average variable cost, and this also comes down initially and then goes up. Notice that the marginal cost curve crosses the average variable cost at the minimum point. And this must be the case because if you consider a point to the left of the intersection, the marginal cost, which is the cost of producing an additional unit, is less than the average variable cost. And that means that the average cost is being pulled down. On the other hand, to the right of the intersection, the marginal cost is higher than the average variable cost, which means that the average variable cost will be pulled up. So to the left of the intersection, the variable cost must be coming down. To the right of the intersection, the average variable cost must be going up, which means that the marginal cost has to intersect the average variable cost at the minimum. And the same point over here, the marginal cost curve has to intersect the average total cost curve at the minimum point. So keep this in mind. On this slide, we have a tabular presentation which shows how the various cost numbers are calculated. Let's consider this row. We are given a total fixed cost, an average fixed cost, which is simply the total fixed cost divided by the quantity. We are given the total variable cost, and then the average variable cost will be this number divided by the quantity.
The total cost is the sum of the total fixed cost and the total variable cost.
The average total cost is the sum of the two average cost numbers, and the marginal cost is the cost of producing one more unit. So if we look at the second unit going from 1 to 2, the total cost increases from 4,500 to 5,250. So the cost of producing this additional unit is 750. Now we will talk about the demand and total revenue functions. First, consider a market where we have perfect competition. In such a market, the demand curve is horizontal. So in this market, each player will see this horizontal demand curve where the market price is over here. This market price is equal to the marginal revenue, which is equal to the average revenue. What about the total revenue? So any firm can sell as much as it wants, and the total revenue will increase in a linear fashion because every unit is being sold at the same price. So this is fairly simple. What if we have imperfect competition? In this case, firms will observe a downward sloping demand curve. So the demand curve will look something like this. The marginal revenue curve will be contained inside the demand curve. So this is a representative marginal revenue curve. What about the total revenue? Now, initially the total revenue is 0. Notice that in this segment, the marginal revenue is decreasing but still positive. If the marginal revenue is positive, that means that selling each additional unit causes the total revenue to increase. So up to a point, the total revenue will increase up to this point. And after this point, the marginal revenue is negative, which means that the total revenue will start coming down. Now this should look familiar. Earlier when we talked about total expenditure, we had a similar looking total revenue or total expenditure curve. Earlier when we talked about total expenditure, we were taking a consumer perspective. Here we are taking the perspective of a firm, and that's why we are talking about revenue. From the consumer perspective, we talked about this part of the demand curve having high elasticity. Now we are thinking in terms of marginal revenue. So the idea is the same, except now we are taking the perspective of a firm. Coming now to profit maximization. This is the profit maximizing. Profit is maximized when the marginal revenue is equal to the short run marginal cost and the short run marginal cost is rising. So let's consider this situation. Say we have this short run marginal cost curve, and let's say that this is our average cost curve, and we have a perfectly competitive environment, and this is our price, which is the same as marginal revenue. Now profit is maximized at the quantity where the short run marginal cost is equal to the marginal revenue, so that's this point. So this is the quantity at which the profit is maximized. Now there might be this other point also where the short run marginal cost is equal to the marginal revenue, but at this point the short run marginal cost is falling, so this will not be the profit maximization point. And again, just to give you the intuition behind why this is the profit maximization point, if you look at the area to the left, so over here, when you produce an additional unit, the additional revenue or the marginal revenue exceeds the marginal cost, so it makes sense to produce more. On the other hand, to the right of this intersection, the cost of producing each additional unit exceeds the revenue from each additional unit, so we should not produce beyond this point. The profit therefore is maximized at this point. So now the question is, what is the profit? So if this is the price, this is the quantity, the total revenue is given by this big rectangle. What about the total cost? The total cost can be calculated based on the average cost. So if this is the average cost, then the total cost is equal to the quantity times the average cost. So at this quantity, the rectangle at the bottom gives us the total cost, and therefore the profit is this area over here. So this is the maximum profit that the firm can realize. Now I want to emphasize that all the costs that we are talking about here are total economic costs. So these include opportunity costs. When we have a situation like this where the economic profit is positive, then other firms are likely to enter the market, which will cause the price to come down, which means that the marginal revenue will come down, and eventually the industry will end up in a position where the firms earn zero economic profit. This will be shown on the next slide. Now what if we don't have perfect competition? Then the demand curve might look like this, which means that the marginal revenue curve might look like this. Now if we have a marginal cost curve like this, the profit maximizing quantity is over here. So again, this is based on marginal cost equaling marginal revenue. Then the price that is charged is read off the demand curve. So this is the price that will be charged. Now what's the profit? The profit depends on the average cost at this quantity. So if the average cost is at this level, then the profit will be given by this area over here. So again, I want to emphasize that profit maximization happens when the marginal revenue is equal to the short run marginal cost and the short run marginal cost is rising. And this condition applies whether or not we have perfect competition. Now here is a common exam question. Is profit maximized when average total cost is minimized? And the answer is no, because you might minimize your average total cost by not making anything, and obviously the profit will not be maximized. So profit is maximized when this condition holds. An alternative way of expressing this is saying that total revenue minus total cost needs to be maximized. Now finally we come to break-even analysis. So the basic idea is that a firm breaks even when total revenue is equal to total cost, or alternatively the average revenue is equal to the average total cost. So what does this look like in a perfectly competitive environment? Let's say you have a short run marginal cost curve which looks like this, and let's say that this is your marginal revenue, which is the same as price. Now if the average cost curve looks like this, notice what's happening. The profit maximization happens over here because marginal revenue is equal to short run marginal cost, and this is also where the average cost is intersecting the short run marginal cost. So at this quantity, this is the price and this is also the average cost. Since the price here is equal to the average cost, this means that the total revenue is equal to the total cost. So that represents the break-even point. What if we have imperfect competition? Now this would be the demand curve, this would be marginal revenue. Profit maximization happens at a point where the short run marginal cost is equal to marginal revenue. So in this situation the price will be set based on the demand curve. So that's the price. But if the average cost is also equal to this amount, then we say that the firm will be breaking even. So the key point to remember is a firm breaks even when total revenue is equal to total cost, which is the same as saying that average revenue is equal to average total cost. Now in our case, when we talk about breaking even, we are saying that the economic profit is zero. Economic profit is zero does not mean that accounting profit is zero. So we've talked about this before. It is possible that the economic profit is zero, but the firm is still making an accounting profit, and this accounting profit will be equal to the opportunity cost. So this accounting profit will be covering the opportunity cost of all factors of production, and in this situation we say that the firm is making a normal profit. And again, I talked about this earlier. So the normal profit is equal to the accounting profit when the economic profit is zero, or alternatively the normal profit is equal to the opportunity cost of all factors of production. Coming now to the shutdown decision. Now clearly this is an economic decision, so again, as I've been emphasizing, all the costs that we are talking about here are economic costs. So let's consider a few basic situations. One situation is where the total revenue is greater than or equal to the total cost. In such a situation, it makes sense for a firm to continue operating both in the short run as well as in the long run. But what if total revenue is greater than total variable cost but less than the total cost? So we are meeting our variable cost, or meeting or exceeding our variable cost, but the revenue is falling short of the total cost. In such a situation, it makes sense to continue in the short run, but it does not make sense to continue in the long run. If the total revenue is even lower than the total variable cost, then a firm should shut down in the short run and exit the market. Now let's understand these situations graphically. Say this is our marginal cost curve, and let's say that this is our average variable cost, and this is our average total cost. Now if the price level is high, so let's say this is the price level. Now price in a perfectly competitive environment is the same as marginal revenue, which is the same as average revenue. So in this case, the optimal profit maximizing quantity is over here. So this is the quantity. The price is high compared to the average total cost. So clearly there is an economic profit to be made. But what if the situation is slightly different? What if the price level is over here? If the price level is here, then this is the same as our average revenue. The average revenue is equal to the average total cost in this situation. So the firm will be breaking even. That's why we say that the minimum average total cost, so this represents the break-even point. So this. Now coming to the shutdown point, notice that the minimum average variable cost, so the minimum is over here. So this is the shutdown point. So this quantity over here will represent the shutdown quantity. And this should be fairly intuitive. If the price is below that point, so this is the price which is the same as average revenue. So if the average revenue falls below the average variable cost, then clearly the firm should shut down in the short run and exit the market. So that's why this is called the shutdown point. If the price is in this range, then we correspond to this row over here. So if the price is here, which means the average revenue is at this range, this implies that we are covering all the variable cost and some of the fixed cost. So it makes sense to continue in the short run, but shut down in the long run.